Welcome to 20 Minutes of Clarity. I'm your host, Jason Noble, with my co host, Andy Merchant. So excited for this conversation. We're going to be talking about cash flow. What a fun conversation. But I'm telling you, you're going to pick up one or two things in this dialogue, and you just take it back to what you do. It's going to put you in a better situation. So let's just dive right in. One of the questions that I keep on getting, especially with everything going on with this environment right now, is what's the best way to pay off debt? And, the Federal Reserve's raising interest rates. I'm seeing credit card debts coming in at 28. I saw one at 32%, right? But then people that going into mortgages, that mortgages are going up higher. Andy, jump in. What are you saying
Yeah,
there?
I had that same question. I literally got an email yesterday from a client who was like, "My rate's now 9.25%. What are our alternative strategies?" Right, and so and I reminded, it's like, we're not going to go out and find something cheaper. The cheap days were yesterday, and then the day before, and the month before, and the year before. Those rates aren't going to come back for a little bit. So we are going to be in a time frame where we might have to pay higher rates. But if you are out there, let's tailor it straight to more of the high net worth clients. There are brokerage companies out there today. Take Schwab or take some of the other partners we work with, and as an advisor, we can make phone calls and we can reduce rates. And so, you may not get that 3 or 4% rate that we were used to for a number of years, but right now we just need to be aware of it, understand how it's going to increase, is what I told this client, and then have an efficient cash flow strategy to pay it down. And we may just tread water for a year if cash flow is not supported.
Well, going back to like paying off debt, right?
Yeah.
There's a technique that I have used in the past, and I'm going to have to start using again. Is where we call the credit card company and saying we are going to cut up this card if you don't lower this rate. And the answer is always going to be no until you ask the question. And you just take scissors, right? I got them right here. You just take scissors and you just start doing this. We're going to cut up that card if you don't lower this rate. And you know what? All of a sudden they figure out a way to lower the rate. But that's just that's a Band-Aid over the problem. What I'm looking at, okay, is with my experience with debt payoff. I had this couple I work with. They're awesome. They had $230,000 of debt, not including their mortgage. This was personal debt. And when I got done, like his debt, she goes, "Are you ready for mine?" And that was already a full page of data, right? Okay, Andy.
Wow.
So I remember this conversation, even though it happened 6 years ago. I remember it like it was yesterday. So then we started looking at her debt. It was 230,000 total from my memory. Well, they're debt free today. They're debt free today. They only have their mortgage. That's the only thing they have left. And what we did is we looked at debt snowball or a debt avalanche approach to start tackling this debt. Now, the great thing is they had discretionary income. So we were able to put an extra $2,500 a month, and where we were able to pay the minimum payments and put that extra $2,500 a month towards their other debt. Now, the debt avalanche and snowball approach, for those that are listening, snowball, you're just taking the lowest balanced one first so that you could get some early on wins, and that creates momentum. So there is psychological benefits there. And money is psychological. Don't let anyone fool you, right? So we learn that from our parents and people around us and stuff. But professionals, we have to check those biases at the door. So the second thing I did is I looked at the debt avalanche approaches, where we go after the highest interest rate debt first. By looking at the two, we saw that by using the debt avalanche approach, they were going to pay off their debt by a year and a half early. Now, we started the debt avalanche approach, but they weren't really seeing the traction they wanted to. So we switched over to the debt snowball, to get them early wins. And we went back to the avalanche. And that's why they were able to be debt free as soon as they were, because I modified my recommendation based off of what was going on with their personal finances and how they were thinking about it. So if you're not familiar with what I'm talking about, this is something that you could look up online, or you could reach out to us. This is so important that we have this conversation over those two different approaches. But it comes back to what you were saying, Andy. It's cash flow. It's cash flow, right? Money
Which is
in.
yeah,
Go
which is
ahead.
the number one thing, the number one first step we do in clear picture analysis. Without optimizing cash flow, it's very hard to make decisions on every other aspect of your life. And when it comes down to debt management, and implementing the strategies, right? You're a master at implementation, right? But implementation is only effective as the data and the direction that we can do in order to commit to that plan. And understanding cash inflow and outflow needs to be first, right? And then identifying, to your point, what assets can we reduce? If you happen to be that client who's got that additional cash flow, like, that's a lot easier equation to solve than that client that's still living paycheck to paycheck and adding to that debt. And so it's a real conversation that you got to start up front.
Well, I'll share a conversation I had earlier today. This individual is bringing in $13,000 per month before, and this is after taxes. So I'm like, well, how much are you spending per month? He goes, well, 6,600. I'm like, oh, okay. So you must have a lot in cash at the bank because, that's a lot of, extra flow there.
Yeah.
He was like, well, no, I don't. And I'm like, well, so why don't you? He was like, well, I have, these credit cards. I'm like, yeah, I see the credit cards. Is that part of the 6,600? He goes, no. Well, okay, so the credit cards are 4,000, so you're spending 10,600. You should still have like cash at the bank, with because you're bringing in 13,000. Well, no, I don't. So how much are you spending? Like, I don't know why he was telling me this or that. Listen, when you're working with a professional, we don't have any judgment. Just tell us what it is. With the facts, I could provide you concrete, solid information so that you could make a better, well-informed decision. But if you're telling me you're spending 6,600 and you're making 13,000, guess what? I know how to do math really well. And I can figure out that's not typically what you're spending unless you have a lot of money at the bank.
Yeah.
Right? Or you're putting a lot of money towards long-term investments. No, this individual had $100,000 saved up, and I knew he wasn't putting towards investments. So I assumed he was putting it towards the bank, and then I realized that wasn't the case.
Yeah.
By the time we finished the conversation, he's actually spending about $13,000 a month.
Not 6,600.
Not 6,600.
Yeah.
But if he would have started off with that in the very beginning and had that conversation with Justin Green, our paraplanner, right? Then when we met, we would have been able to go more into what was important and relevant rather than spending 25 minutes on how much do you spend? Like, that's a simple question. Now, the answer could be complicated because how many people actually know what they spend? I think that's so important. Just to know what you're spending your money on, that's telling your money where you want it to go. Yeah. Now, if you do a budget or if you use an app or something and you see where your money went, that's better than nothing. But that's just telling you what has already happened. Get to the point where you're telling your money where to go, and then that's where you're going to start seeing your financial life really take off.
Well, and let's add to it, right? I mean, knowing where your money is first and then developing the strategies around it to reduce debt or to, and debt's not been a bad thing. It's still not a bad thing, right? Because debt's leverage. It's what you're buying, and that's the thing I look at is let's go pay down because there's some arbitrage, opportunities. And one strategy I think I might add for those that are maybe tuning in or listening is, again, our focus is let's talk outside the traditional box. Walking to an advisor, you might get the same old story. But you know what? A great opportunity. I just did this, Jason, the other day with a client. I called it proactively ahead of it. Life insurance policies that have built cash flow all these years, their rates have moved as well, right inside the borrowing rate. But a lot of people don't maybe have understood the power of borrowing from your own insurance policy and the fact that you can actually call in and request a locked in or reduced rate on assets that remain yours. And you have more control of your cash flow as well as still maintaining your death benefit and things like that. So it goes back to you can't do this on your own. You can't go find a jack of all trades who doesn't know how to master it. That's where our partnership, within our firm and within our other groups out there, we dive into it. But my exact story was I had a client. It's interesting. He was looking to add debt. We wanted to buy a new piece of land. And, going to the bank's one thing, right? We can go borrow money. They're going to give us a rate. We got some ideas around how to work with our professional bank partners to help our clients out at times or encourage our clients to ask the right questions. But I just said, well, you've got your insurance policy. It's kind of a short-term finance deal. Why don't we just call your banker and see if we can renegotiate your borrow rate out of your policy? So current rate on the policy was probably 8.5%. We were able to go in, request it. We got it locked in for the next 12 months at 5. I mean, think about that as one phone call, save this client. Let's, pick your number, multiply it by a 3% savings. That's added cash flow back into your pocket that you can apply for maybe other debt that you don't have out there. And my second point on all this is that it was sticking on the insurance story is that depending on how your insurance policy was designed, they usually have two different components. You just have to ask the question. If you want to borrow it, you can do a participating loan. And I'll explain maybe a bit about that while we're just chit chatting a little bit. But then they also have the non-participating loan, and in the non-participating loan, it's if their standard rate's 4.5, you borrow at 4.5, they credit 4.5. So you don't get any growth on your cash value, but you're not paying any interest. So if you think we're going to be in a stable, no growth environment for the next 12 months, why not talk to your professional and have them consider that and run the scenario? If you think there's upside in the market, then play the little arbitrage game, right? We want to see if our interest rates are low enough for what the market can give us.
So let me just break down this because you're getting into, and I like it, Andy. But here's the thing: we're talking about cash flow, and you're talking about using and leveraging assets that are in the balance sheet to be able to supplement cash flow needs. That's what I'm breaking down for everyone that's listening. Now I'm picking up what you're putting down, right? But not everyone is a CFP, right? So let me get into this part, right? We're talking about cash flow, and I get this question: how should I budget for my living expenses? And budget in my office is a 4-letter word, because like nobody sticks to a budget, but it's understanding what your living expenses are and where you are in your financial journey. It goes back to telling your money where to go and what you should be doing with it. Now, there are some ratios that are important, like for those who are like saving up to purchase a home, let's say, right? And an important ratio is debt to income ratio. And what they look at is two different factors when they're getting approval for a mortgage, right? And it's 28% and 36% are the debt to income ratios that are coming into an account from when they're looking at pre-qualifying. So working with this couple, they have a lot of student loan debt. And it's that student loan debt that's driving their debt to loan ratios out of whack. Now they have great income that's coming in, but a lot of that money is tied up in, being a lawyer and having that debt.
Yep.
But we were able to make some adjustments, adjust not only to their debt, but we recasted some of their debt, which was awesome. What we refied and then we recasted it. And in here in Charleston, there is a mortgage person who specializes working with lawyers. That's my job to know. Now, my client didn't know that, but I was able to make an introduction and they were able to get them a better rate. Yep. And now they're getting pre-qualified for a mortgage where they couldn't do it before because of the ratios. But, so how much should you have for living expenses? Listen, you don't want to be house poor, right? Like you got the house you want, but you're paying an arm and a leg for it and you can't furnish it and you can't do anything else. You can't hang out with your friends and can't do anything and you can't have your kids do anything because all the money's going towards the mortgage. But Andy, I know you got some thoughts to this because we talk about cash flow all the time. What are your thoughts on how much does someone budget for living expenses?
Well, I'm the same with you. I mean, I don't think ever has anybody ever walked into the office and said, "Here's my budget." Budgeting is the hardest thing for people to do, and sometimes you just have to work into it. I tell clients all the time, you kind of have an idea of what you spend, but let's take away, all those, house payments, out of that mindset, that equation. Let's take out your insurance payments. Let's take out your tax estimates. And let's just get down to it. How much do you want to do to go out and have food and live your lifestyle? So we call it lifestyle expenses in our offices, right? Mm-hmm. I mean, it's what you're living on, and then all the other stuff will factor into it. So a lot of times when we're working with clients, all right, Jason, we'll start with a number and then we'll kind of refine it to your story point. We solve for what's called unallocated, savings. So if you got to run your household like a balance sheet. It has to balance. You got so much coming in and so much going out. And if you're not intentionally saving, I know you do a lot with a lot of the programs you built that I want you to jump into and talk a little bit about that maybe for brief, but you got to start with an understanding of your balance sheet. And then you can start having what we have with clients is a much more intentional conversation during the Clear Picture program that helps us identify maybe if there's some additional spending than what their budget might have been.
Yeah, it's about money in, money out. And what do we do with the difference? Are we taking that difference and putting it towards debt? Or are we taking that difference and putting it towards, let's say, emergency savings because we need to
Yep.
have access to that if something comes up unexpected? Or were you taking that money and putting it towards longer term investing? Now, one
Yep.
of the things that I saw as a retirement income certified professional is that transition into retirement, people were going, they're so used to getting money from their paycheck. And then all of a sudden now they're getting the money from the portfolio. So we created
Yep.
Portfolio Payday, which was to help initially our clients that were nearing retirement. Money will go directly into their investment account and we'll build an emergency savings. And once they hit certain thresholds, we were able to put it toward long term investing. And then we're sending money out on a regular basis, the lifestyle paycheck on the 15th and 30th of every month. Pretty easy, right?
Yep.
Well, next thing you know, my clients that are enrolled in this program, they're going, well, wait a second. What about my son or daughter? They're having issues with their cash flow. We start doing this. Oh my goodness gracious. I have clients that are in their 20s and 30s and we're doing Portfolio Payday. But I'll just break it. We're flipping the banking system on its head. There's been a lot of things going on in the banking system that's causing a lot of mistrust, and it's rightfully so. So what we're doing is the money is from payrolls coming right into the investment account. Inside the investment account, you're working with a customized portfolio with your advisor to build out that customized cash flow. How much money should be built in emergency savings? Now, once we hit a threshold, that money goes towards longer term investing. So right from that account, I'm actively engaged with my clients in building out their financial plan. One of my clients goes, hey, we got to increase my lifestyle paycheck by $200 a month. Done. It was as
Yep.
easy as making a couple clicks and getting that extra money out on the 15th of every month. But here's the thing, they went from saving $250 a month towards long term investments. And right now they were saving $2,500. Now they're saving $2,300 per month towards their long term investing. They're 32 years old. You just look at just like what are the compounding effect of that's going to be by the time they turn 60 and all the way through their retirement? What does that look like? Oh my goodness gracious. It put an injection right into their financial plan. And now they're being able to communicate with me, which I love communication. That's a cornerstone of any relationship. They said, hey,
Yep.
well, you know what? I got this trip coming up, and this trip is going to cost me, let's just say $12,000, and I'm going to do it next year. I can start sending out an extra $1,000 a month right into their savings account so they could take that trip. They could use their credit cards, get the points, but that money's going to be spent right there from and paid off right there from their savings. They're doing it tactically with a professional that's putting them in the best position possible to navigate through that versus going on that trip, loading up $12,000 on credit card debt and everything, paying 28% on it. No, we were able to plan ahead from it and be able to do the cash flow optimization through by our service. Now, if you're interested in learning more about the way we work and cash flow optimization and the things that we were talking about today, go to clearpicturefinancial.com. Go to tools and go to Portfolio Payday. You can watch a video that Andy and I put together. We're very proud of this video. You can set up a meeting and we can have a more in-depth conversation with you specifically around your finances. I'm Jason Noble.
And I'm Andy Merchant.
Have a beautiful day.